it's often said that the private markets are broken. They're especially when it comes to family offices have struggled, but then I think there's the next wave where RAs or high end RAs advisors are looking to allocate to private markets as well. Why are there so much friction when it comes to private markets, especially compared to public markets? And what are some of those key friction points family office face when they're investing in the asset class, and what can they do about it?
It's funny. I think that two things I want to hit on that Ryan was just talking about around how like over the last 7 years we've evolved a lot. I think that the appetite for alts has evolved quite a bit as well. It's become a lot more prominent in a lot of clients' portfolios, but the technology and the infrastructure to support that is not. And I think that's what's been really challenging for a lot of these firms is they start allocating to private investments. And this then becomes a 7, 10, 15 year burden that you have to manage for on behalf of your clients. And so I think that, one is just access to the data. It's not available in a custodial account like your private investment or like your public investments are. So you just don't have a single source of truth. You don't have a single place where you can access this information. The reporting is a lot less frequent. You're getting maybe a monthly, maybe a quarterly update on these investments. And so there's just less actual activity on these types of investments. But you want to know, where you stand and have a sense of, the latest, value and unfunded commitment and like what your liquidity needs are going to be. And so I think part of it is that the market is catching up to the demand for alts, and hopefully we're helping drive some of that infrastructural change and shift. I think the other component of this is that the private investors have kind of been like an ignored space. I don't know what your thought is on why that is, but I think there's been a lot of new players coming into the market over the last like 2 or 3 years. All of a sudden, everyone has a lot more appetite to explore solutions here.
Yeah, well, it's like institutions have been allocating to alts for decades. We have Dave Swenson from Yale, who was a big early advocate of even having like 30, 40, 50% of your portfolio in alternative investments can really drive returns. And then firms like Cambridge Associates caught on to that, and it had an early white paper around how 40% alts is great for long-term returns if you don't need liquidity, if you're the type of family office or institution that's investing for decades. And now that's starting to trickle downstream to more individuals, more multifamily offices and RIAs. And both like there's demand and appetite, but asset managers also, as they look to grow, the net new flows in the industry are going to be predominantly driven by the wealth channel rather than institutions going from 40 to 42%. It's people that are at 3 to 5% going to 8 to 10 to 20% alternatives. We think that that's going to drive a lot of adoption in a place that doesn't have tools, but expects really good tools and expects really good interfaces. Because if you're an institution, you have been doing this for a long time, you have well-oiled processes, you're managing billions of dollars of capital, and it's okay to throw bodies at this problem and have people that will go into portals and pull information and put it into the systems that the investment teams or operations teams are using. But if you're a family office or an individual, we just have this perspective on like that doesn't work for you, especially when you might now have dozens, hundreds, or thousands of investments where you didn't have those before. So it becomes a major crippling point for firms that are trying to grow in this space and serve more of that type of client. But also people just like demand and need better client experiences. So that's a big guiding force for us is to build the experience that these clients need and deserve and might not be getting otherwise.
I heard even family offices are underallocated to alts by up to 20%. They're chock full of them. Certainly, when you look at the wealth channel, that some have no exposure to it or minimal exposure to it. Maybe a client comes with it. Have you seen any differences? I know there was hope back in the day with like ILPA, maybe CalPERS trying to force some sort of standard or greater access to data, but are GPs more willing to provide data? Have you seen a change on the way GPs are offering information? Are GPs more open and receptive to how the operational challenges that maybe LPs are facing?
Yes, because as more GPs look to bring in more high net worth wealth channel type of capital, they're thinking about like, okay, those clients need a better experience around managing their investments, and they also want to make it easier for people to buy investments. It is like, in some ways, if you look at like a pessimistic view of the industry, it's shocking that people do want to invest in alts. Those, all of the pain points and heartburn you have to go through before you even buy the alt, like the subscription process and logging into this portal to get the documents to understand on page 97, this is where they talk about the fees and this limited partner agreement. And then once you own the investment, you get 14 to 20 communications a year that you need to go back into the portal to get that communication, to route the K1 that comes late to your accountant, to complete the capital call in 10 days. So a lot of work, a lot of burden.
Oh yeah. By the way, we put all the important information in the footnotes too, and then we're gonna capture it into a PDF, right?
Of course. So, and they're like, aren't great data feeds today. But it's like, okay, well, the optimistic reason is like, why do people invest in this asset class? Well, it's a higher return. You want 11% instead of 7% or something equivalent to that.
We're looking for alpha, right?
Yeah, it's more interesting. It's a different correlation. And so there are a lot of reasons why alts are great for folks. And I think there's GPs who are now thinking about, okay, how do I make it easier to buy, easier to understand, easier to manage your investments post trade? And so we're having a lot of conversations with folks now around other ways that we can help them access the ARC toolkit or solve some of these painful problems. So if it's something that you, a listener of this podcast, are actively thinking about, we'd love to discuss with you, because we are also thinking about ways that we can create industry change. One last thing I'll say here is, like, when Arch was initially founded, it was 3 people. Took us 3 years to get past $1 billion in assets. Who would listen to us? If we went to a large asset manager and said, hey, can you create a better standard or create something that makes our clients' lives easier? They'd be like, not on our roadmap, not something we're interested in. Today, we have some of the largest asset managers in the world proactively reaching out to us saying, hey, we now see that you have dozens, hundreds, sometimes thousands of positions within our funds. How can we make this easier for you and then for our team and for the NLP? And that's the type of conversation we want to continue to drive.
The only thing I'll add there is I think that there's been some adoption of standardization across some of the largest managers. I think what's challenging with alts is it is quite a fragmented industry, and there are a lot of smaller, more boutique managers that clients want to allocate capital towards because it's a unique investment opportunity. It's great diversification. They want a portfolio that has a mix of some of the larger managers and maybe smaller ones. And so that has been a challenge as well. And that changing the entire industry is quite difficult when there is some concentration, but there's a lot of fragmentation as well.
You know, when I was talking to family offices a while ago, we were doing some research into this problem. One described it as this, especially as first mile data aggregation, as cleaning bathrooms in the airport. Right? Like, nobody wants to do it. Somebody's got to. And often it's the CFO that's doing it, right? That it's a high valued employee that needs to be able to translate that information. Where do you see in the arc of the industry, like in terms of automation and transparency around this particular asset class for family offices? Are we first inning, third inning, sixth inning? Where on your experience, like, where's the adoption? Where are we in the adoption curve?
Yeah, I mean, maybe inning 2. I think that there's a lot of room left to run. This industry is really not automated. You still have lots of clunky subdoc processes. There are some great solutions that have come in trying to digitize subscription documents, mostly from the GP's perspective. Take the subdoc, put it into a digital form, give it to the LP. Those are much, much better solutions than giving someone a PDF. So that's great. But then, like, manager A might use one provider, manager B uses another provider. So we're still in this like highly fragmented, highly siloed industry. And we really believe in this best in class ecosystem of solutions that can talk to each other with the ability to like provision data from one tool to the next. So if you're using Arch and then you want this data to go into your Adapar or your Archway or go to your accountant, then you should be able to be like, great, I want to send data to this system, this person, this organization, and be able to create a lot of collaboration between different tools in the space.
I think it's important not to have the digital rails. Like, this stuff doesn't live on an island, and that it's important to be able to integrate into the broader tech stack.